Hey YouTube, I'm going to take a few minutes today. I just had a bit this afternoon to take a look at the money supply. You know, the Fed says we're tightening, raising interest rates to combat inflation, and I just want to take a few minutes to look at what that means to them and see, kind of what the effects of that are and what the numbers actually show that they're doing or not doing. And so I wanted to jump into that real quick. And we're going to start at the M0 money supply. M0 money supply, we'll look at this, is cash and liquid assets and, things in the bank and currencies, things like that. Things are easily spendable. Now, we're going to skip over most of the M1 money supply because the definition just changed and go straight to M2, which is the most full view they have today of money supply, which includes short-term notes and some things like that. But our idea is to say, what did they say they're doing and what are they doing and what are the effects on the market that we've seen so far to see maybe what's going to happen in the future. So M0, most liquid change. M2 includes M0 and M1. And some short-term deposits. And it's not important to understand. What's important to understand is one is very, very liquid, and the other one is more reflection of total money in the system. So let's first look back at some houses. Here's a house, and 2020 price went up. Okay, here's another house. 2020 price starts going up. Stock market, you're familiar. 2020 January, price starts going up, and now it starts coming down. Why is it coming down? Is money coming out of the supply? Let's look at that real quick. This is the M0 money supply. M0 money supply is coming down. Now, that means there's some liquid money coming out. Now, why is it coming down? Well, someone is taking money out of their bank account and putting it on some type of debt obligation, most likely. I did some. I think I've paid about $40,000. So taking it out of here, putting it into debt destroys that money. Now, let's see what the government is doing, because the government generally doesn't keep cash in their balance sheet like that, and they don't pay off debt. So we'll look at the M2 money supply. This is the M1, which you'll see an accounting change here. So we're going to ignore that because it's just noise. Let's go straight to the M2. Now, here's February 2020. Starts going up, goes up by $2 trillion, continues to go up 18. We're going from 15 here all the way up to here to $21.74 trillion at the peak. And now we start tightening. What does tightening look like? How much money has been reviewed? Well, right now, it says we're at 21.67, so 0.07 trillion out of 21 have been actually removed from the money supply. Now, you'll say, with that small amount, why is the stock market down? Well, stock market is based on expectations. And because interest rates are expecting to go up, they expect more people to pay off debt, which takes the M0 money supply, so they're expecting the money supply to go down because of that. Is that going to happen? How is that going to happen? Where is the money going to come from? What should you be doing? One perspective I have is I have rental houses, and in the end, I own rental houses. No matter what the value of the rental houses is, I'm still renting houses. That's the business I'm in. Some of them are probably 30% below value today because I haven't adjusted them all. And so slowly those will probably rise over time. So my net rental income is not going to go down no matter what happens with the value of the houses. And so because I'm not selling right now, it means it doesn't matter. Now the interest rate on debt is definitely going to go up over time, and so that's something I have to plan for and a big thing. But what I wanted to show you was the reason basically the inflation is not going down is because the money supply hasn't changed. This is not a reduction in the money supply. Reduction in money supply would be this 21 goes down to 20 or to 19. So they're just taking the money out of your pocket. which is the M0 money supply. They're not paying off their balance sheet. They're not reducing the M2 money supply. They are not even hardly affecting their own spending. They're only targeting your spending as the reason for inflation because of their misunderstanding that government causes inflation. So this inflation from 15 to 21 is pretty significant. Not as high as the M0 money supply inflation, but a good probably 40% inflation. And so if you look at inflation numbers, you saw maybe 5 the first year. Now you're looking at more 9.1 on top of the 5. So 15% inflation is what we're at right now. I think that the net inflation will be, the difference in money supply because the money's worth less, and then, minus some reduction based on efficiencies in the economy. And what they're worried about is that if wages catch up, then your inflation might be spiraling out of control, and out of control might be just compounding. And then what happens is your money supply didn't go up, and so people actually have less money. There's less velocity on the money, and you have a real problem with things being able to be purchased, and that's what puts you into more of a recession, a depression type situation. But I wanted to take some minutes and just explain that to you. M0 money supply, M2 money supply. I heard some interesting inflationary discussion, and I hadn't thought about this in the past because one of the things we look at is the VIG, and that's just a broad market index fund that I have money in that tracks, dividend paying stocks, profitable companies, things like that. And so I wanted to kind of introduce the concept that I heard from when I was listening to videos was that this 125, 127 was measured in pre-COVID money before that large increase, right? And so this 27 and this 27 are not the same. So back over here, when you're at 144, it's now with less valuable money. And I know that doesn't make any sense, but let's just say this $144, you can go out to eat less than this 127. So maybe we are back down at a number which is lower, and that's a possibility. It gets pretty complex to track some of these things. What I would say is I'm continuing to dollar cost average into Walmart stock, get into positions and companies you want to be in, have a monthly amount you set aside into index funds, and a place where you're not touching it, because everybody gets caught up with inflation and taxes and those things, and really your behavior is much more of a tax on your wealth than any kind of inflation and tax that the government could put on you. So your wise behavior will be the best thing you can do. But I wanted to share that with you today, so you had a good idea of what M0 money supply was, what M2, and you weren't fooled into thinking that the money supply was going down, because it's not. You can check this link out and see that. Just look it up on Google, M2 total money supply, and it'll show you month over month. So they aren't fooling really anybody at this point. And we'll see how that M2 money supply goes down over time, if they actually make any adjustments to it, like they did to the M1 money supply as people paid off some debt. I think they're expecting this to come back down, and that to curb inflation. But I'm not sure if that will curb inflation or if this M2 money supply has to go away, which this requires specific action from the federal government, which they haven't taken yet, to get some of the debt off their balance sheets and pay off some things and stop spending so much. But hope you enjoyed the video. Hopefully I gave you a little bit of guidance on how to react in these times. This is a time that you should be systematically acquiring, good companies, good ETFs, and also having a cash portion waiting for that reactive market. I'll talk to y'all later. Bye.